Hi, I'm Lindsay from CoSec Kadari Securities, and today we'll be discussing earnings. It's one of the key fundamental metrics utilised by CoSec as part of our evidence-based investment strategy, and it provides significant insight into the future profitability of a business and its prospects for long-term success.
As always, all information given is general in nature and does not take into account your personal needs or objectives. For further information, visit our website www.cosec.com.au. So today, we'll provide an overview of this financial metric. We'll then explain how it's calculated, and finally discuss why it's important to equity investors and provide some practical examples from companies listed on the ASX. As mentioned, earnings provide an insight into the future profitability of a business and its prospects for long-term success, and are therefore a crucial consideration for equity investors. They represent the net income generated by a business after deducting all expenses, and they're the bottom line of a company's income statement. So how do we calculate earnings? Broadly, earnings are calculated by taking revenue, then deducting variable and fixed expenses, depreciation, interest, and taxes. It's worth noting that there are a variety of alternative terms such as income or profit, each with slight variations in calculation depending on the context and objectives. However, the overarching principle behind each remains consistent. So why are earnings important? Earnings are the primary determinant of a company's share price and are referred to as a company's bottom line for good reason. This is because earnings and the circumstances relating to them provide an insight into the future profitability of a company and its prospects for long-term success. Clearly, if earnings are positive and increasing, these are signs of a healthy and viable company. Earnings are arguably the single most important and most studied number in a company's financial statements, and their deviations from a company's prior forecasts, as well as analyst estimates, frequently lead to material movements in share price. Unfortunately, as a result, there is often a temptation for unscrupulous managers or companies to manipulate their earnings figures, such as via creative accounting. Earnings are used in many financial ratios, but the most common is undoubtedly the price earnings or PE ratio. This is calculated by simply dividing the current share price by its earnings per share. The PE ratio is utilized as a relative valuation measure and, all else equal, may indicate that a company is overvalued or undervalued. However, it's important to keep in mind that what constitutes a normal or high or low PE ratio is very much dependent on the particular industry or sector that the company is in. The PE ratio is tied directly to expectations of future growth. If earnings are expected to grow strongly into the future, then investors will be willing to pay a higher price relative to the current level of earnings. For instance, the PE ratios of companies in the banking and financial sector in Australia tend to reside in the 10 to 15 times range, as they're more established and exhibit lower earnings growth. For instance, Australia's Big Four banks currently trade at an average PE multiple of around 13 times, while Macquarie Group trades at a multiple of around 16 times. In contrast, companies in the technology sector and certain segments of the retail sector might trade at PE multiples well north of 20 times, as they are in the midst of expansion. For instance, JB Hi-Fi currently trades at a PE multiple of around 20 times earnings. A2 Milk trades at 38 times earnings, while Kogan trades at 85 times earnings. Of course, a caveat should be observed when interpreting PE ratios. If a company's earnings are artificially low or even negative, its PE ratio will not be meaningful. So in summary, a meaningful analysis of earnings and price earnings ratios should involve a comparison with the company's industry peers, a comparison with analyst estimates, as well as the company's prior forecasts, analyze whether they're stable, trending up, or trending down compared to the company's historical performance and metrics, and also consider broader macroeconomic trends and themes.
So in this video, we provided an overview of the financial metric earnings. We explained how it's calculated and also discussed why it's important to equity investors and provided some practical examples from companies listed on the ASX. So I hope you found it helpful. This video was brought to you by CoSec Kadari Securities.